Greetings accounting students. Today we're going to cover the theoretical and practical aspects of the completion of an income statement. So at this point, always good to basically cover the broad definition of what we mean by an income statement so we have a sense of clarity on the purpose of it. So an income statement, also known as a P&L, a profit and loss statement, simply lists and report the revenue earned for a reporting period and then deducts any expenses incurred, presuming that we're using the accrual basis of recording, and then we report the consequential net profit or loss for that period. So before we get into the practicalities of completing an income statement, we need to be crystal clear on our definitions of the two accounting elements that apply to an income statement, revenue and expenses. So there are 5 criteria for revenue. The first 2 are that the financial event has to either result in an increase in assets, so that will often be the bank balance going up, or in the case of a discount received for prompt payment to accounts payable, it could result in a decrease in our liabilities. The balance on our accounts payable is going down. There needs to be a consequential increase in owner's equity, which will be a result of the profit going up. And that needs to be other than a capital contribution by the owner due to the entity assumption. So we report capital contributions in the balance sheet under the owner's equity section due to the entity assumption that occurs in the ordinary activities of the business. Most of your revenue will be sales or fees, but we do have some other forms of revenue that we need to report. So we can pretty much flip those 5 criteria for an understanding of our definition of expenses. So the first 2 criteria, flip those. The financial event will either decrease an asset, often the bank balance going down, or increase a liability. And there needs to be a corresponding decrease in your OE due to the reduction in your profit, other than drawings, which again is due to the entity assumption that occurs in the ordinary course of the business. So we'll look at the practicalities of this a bit later when we get into the completion of an income statement. So just to give some further context of where this actually fits in with the course, I like to put a bit of emphasis on the accounting process. So our inputs, our receipts, our EFT docs, our invoices, etc. These basically are processed if we're using a single entry system into our special journals. If we're using the double entry system in the Unit 3-4 course, then we're doing that in the general journal and the general ledger. Once we've done that, then we're able to generate our 3 main reports, our cash flow, our balance sheet, and in this vid, we're looking at our income statement. And once we've got our income statement, then we're able to use our ratio analysis to basically analyze our financial information in the form of our profitability. So we can look at our return on owner's investment. We can look at our net profit margin and explore expense control. We can look at our gross profit ratio and look at how our markup is basically impacting profitability. Now, as opposed to a classified balance sheet where we just have 5 simple headings, current assets, non-current assets, current and non-current liabilities, and owner's equity, an income statement, the actual headings will vary greatly depending on whether it's a service or a trading business. Now, in the VCAR study design, it actually has a template for the various reports, including the income statement. I'm doing this for the study design that goes from 2019 to 2024, so possibly this might need an update in 2025. Now, just in the context of Unit 1, Unit 1 focuses on service businesses. So a service business is not selling inventory, and this has ramifications for the headings used, the actual preparation of an income statement. Then when we get to Unit 2 and for Unit 3 and Unit 4, we're looking at trading businesses. Trading businesses buy and sell inventory. They mark it up and sell it for a gross profit. So if we're a Unit 1 student as opposed to Unit 2, 3 or 4, then our income statement is going to be more simplistic than this. So for instance, there will be no COGS, cost of goods sold, because we're not selling inventory. So therefore we can't calculate GP or adjusted GP. And generally we probably won't separate our other revenues. So we're simply going to have a revenue heading. We're going to deduct our expenses, and then we're going to report our net profit. I want to focus on completing an income statement for a trading business that sells inventory. So I feel the need to unpack what these headings represent so that we have a sense of clarity before we actually start with the completion of our income statement. For instance, we have 2 revenue headings. So again, we need to be clear what goes into that upper heading, under that upper heading, and what goes under other revenue. So let's unpack. So revenue is simply the amount earned from the sale of our inventory. Again, this is for a trading business, minus any sales returns, which gives us a net sales calculation. Then we have our COGS heading, which will list and report any cost incurred in getting the inventory into a condition and location ready for sale. So the main one there will be cost of sales, but we might also have some freight, some cartage, some insurance on delivery. And then we can calculate our GP, which is our net sales minus our total COGS. And that gives us a very useful indicator of our markup on the inventory that we've bought. If we have any stock inventory losses, inventory gains, inventory write-downs, then they go between our GP and our adjusted GP. Then we deduct our other revenue, which is our non-trading revenue. So that might be some interest received, a discount received from an accounts payable, etc. And then we list all our other operating expenses, our non-trading expenses such as wages, interest, insurance, our utilities such as electricity. For the theoretical component of the subject, let's just be mindful that we have the 6 QCs that guide the way that we prepare our reports. So we need to include all relevant information into the income statement about our revenue and expenses. We need to faithfully represent that revenue and those expenses to reflect real-world economic events. All of our expenses and our revenue needs to be verified by the retention of our source documents. The preparation of our income statement needs to be completed in a timely manner to help the users of reports with decision making. We need to classify and present our income statement in a way that non-accounting experts can interpret, and we need to be consistent in the way we actually prepare our reports so that they can be analysed over time.